And then we also got an overvaluation read on the global liquidity risk score in December as well. And if you remember back then, you were talking about it, I was talking about it, like dollar was strengthening, like liquidity was tightening as we rallied very, very sharply into Christmas. And of course, then we had the fallout for the next sort of 3 to 4 months. So now where are we? We're at a score of 3. We are neutral. There is sort of that 40% rally off the lows of April is just the normal relationship playing out.
Okay. Super
So
interesting.
the next score, the one we refer to, is called the derivatives risk score, uses several inputs, mainly on perpetuals futures. I'll be pulling in sort of options and other metrics when I can, but here you can see that the timing of this signal, you have to kind of ignore the 2020, 2021 market. That was extraordinary. Funding rates remained elevated for, 12 months. And that simply was just a function of an immature market and also the type of investors that were trading it back then. There's just no way funding rates can, remain at sort of double digits, weeks and weeks and months on end. But if you look sort of more closely to what happened in 2022, it picked the bottom very, very well. And in early 2024, again, when the ETFs were launched, the actual top, the risk score of 5 came very close to the market top. And then again in December of 2024 as well. So this tells that other side of the story. So if you're overvalued versus global liquidity, is it driven by spot or is it driven by leverage and derivatives? If it's driven by the latter, that is a much more serious problem because that unwinds more quickly.
So, I mean, again, brilliant work. So looking at the liquidity risk score, we're neutral. Looking at leverage, we're kind of low, not even
Very.
neutral, we're pretty low, which is suggestive as we go through more of your work that, we've got a potentially larger move at play here because we've got very little headwinds.
Yeah, yeah. So it's exactly very little headwind. If the positioning was so one-sided at this point, especially around an all-time high, like we got in this one here back in Q1, this was pretty much level with the old 2021 high. So you had old resistance, but you also had far too much leverage and positioning all one way right at the top. So it was just it was a recipe for a pullback. We don't have that now. So it's just, it's very, very muted, which is great to see.